Hi, Modern Phoenician. Technical analysis is widely used in the world of finance and trading. If you are looking to have basic understanding or simply to manage to read a candlestick chart, this video is for you. By the end of this video, you will manage to know what does a candlestick consist of. Second, you will know different type of multiple patterns that I personally prefer because I feel it has the highest level of accuracy that may let me or allow me to predict the future in a better way. Third, last but not least, my recommendation that you may find helpful if you aim to take technical analysis and trading to the next level. Welcome to Modern Phoenician page. My name is Ali, and without further ado, let's jump and see what does a candlestick consist of and my favorite pattern that we are going to discuss just shortly from now. As you can see here, we have two candlesticks, one in red and one in green. The red candlestick, I guess you guessed it, it is bearish candlestick, which means the price is moving to the downward. Green candlestick, it means the price is moving upward, the price is bullish. So a candlestick consists of a body. The stiff, rigid part of the rectangle is always called the body. The small two lines that you can see from the upward and to the downward, it's called wicks or shadow. You have upper shadow and lower shadow. Whenever we having a candlestick that is bearish, always the price starts from the top and close at the bottom of the range or bottom of the rectangle or candlestick. And oppositely, whenever we have a green candlestick or bullish candlestick, the price open from the bottom and close at the top because the price is appreciating, the price is going to the upward. That's the only difference between the two candlesticks. And as we can see in the cycle and the charts, it keeps repeating itself through different form and shapes, the same candlesticks. Now let's move to the patterns that I have picked for you, starting with the hammer. Hammer, it's the only single pattern candlestick formed at the end of a downward move, which means a reversal is on the horizon. It may happen as fast as we close this candlestick, because as we can see, we have long low shadow. This wick has been bought right away at the bottom of a move, and then what we are supposing to have is continuation of a price action and appreciation in the price for the couple of candlesticks that is coming later on. But we always put a strict stop loss at the bottom of this wick. Moving on to the second pattern, which is a bullish engulfing pattern. It does consist of two candlesticks. The second candlestick, it engulf or cover fully the first bearish or red candlestick because it has to indicate that the continuation of a downward is no longer applicable at this level, because it seems like there's a huge volume of buyers entering the market at this level. And where we put the stop loss, of course, at the bottom of the neck or the green candlestick. Moving on to the morning star. It is my all-time favorite pattern among those because mainly majority of the time it has higher level of accuracy, let's put it this way. It consists of three candlesticks. One of them is bearish because we are in a continuation of a bearish movement followed up by a doji, and then we gapped up and seeking to continuation of a upward move, which means there's a reversal at the bottom of it. But we do never enter such a trade before the close of the third candlestick, which looks so strong for continuation of appreciation in a price for the next couple of moves. And of course, where we put the stop loss at the bottom of the second candlestick. As we can see also in the chart, we can find the price and find our stop loss. Moving on to darker cloud cover candlestick pattern. It does consist of two candlesticks. It comes also at the top of a range of an upward movement. However, the price gapped little bit to the upward, then gets sold right away. And the level of or the size of the second candlestick should be more than 50% of the green candlestick, which tell us in other ways that the price or the level of selling is so strong and the seller are taking over the bullish movement that has occurred before, and we are most probably going to continue to a downward move. That's why we put our stop loss at the top of the second candlestick and we ride in profit for going to the downward. That's and only that if we had the pattern that is accurate and turn on to be successful. Sometimes we just fail, we have a failed pattern, such as it could happen here, and the price just reverse and go all the way to the upward. Whatever happen will happen. We can't even say there's certainty in the market. The only thing that could save us is having a stop loss on the right spot on the right time. Moving on now to the evening star. Evening star candlestick patterns. It's quite obvious that it does come at the top of the movement. After a long bullish movement, you see like the buyers are getting a little tired and the sellers are taking over, but we do not ever enter this trade before the close of the third candlestick, which most probably will tell us that we have strong sellers coming into the market and the volume has to increase. That's why we should ride this move all the way to the downward with the right strategy and put our strict stop loss. Also, we can check this chart that confirm what we have just said, but again and again it doesn't always happen, so that's why we need to be careful. Falling 3 method candlestick pattern, we see a strong downward movement followed by 3 small green sticks or candlesticks, because as we can see here, those are shallow, shy movement. There's not much buyers, followed up by the 5th candlestick, which is so strong and push the price all the way to the downward. That's why after waiting to this pattern just like be more clear for us, we can enter after the 5th candlestick and ride the movement to the downward with a strict stop loss at the top of the move. Moving on now to our last candlestick that we should never trade, which called doji candlestick pattern. As we can see here, it has 2 huge wicks, which means there's a lot of uncertainty. Buyers and sellers are almost, no one is winning, no are equal, because there is a small body here. The smaller the body is, the smaller the green or the red is, the stiff red or green we spoke about before. That means there's more uncertainty in the market. All what we have to do at this scenario, just wait, see, wait for a better pattern and clarity in the market, then enter at another time and other trade. This one never into trade. And now we finish what we have promised to deliver for today's video. But before we leave, we need to move on to my recommendation for whoever want to take this trading to the next level. And to wrap up, let me give you some recommendation and discuss with you some stuff in regard to trading that has to be clear. And most importantly, to start with is stability, emotional stability. It's like a roller coaster. Once you get your hard-earned money involved in the market, it will be tough for you to gain control of yourself and your emotion. Believe me, you need to start first by studying yourself, knowing more about yourself before you get into trading the market with your money. Or you can as well paper trade. What is paper trade? It's just free trading account or demo account that you can use and try different type of strategy and see how consistently winning your strategy is going to be. So you gain some confidence. Once you get into the market, you at least start step by step putting some of your hard-earned money in the market. And with time, you will gain more confidence, you will gain more knowledge, experience, and then maybe, hopefully, you will be consistently profitable at certain level, but never before you start trading as on a demo account and knowing more about yourself and the market in general. It is not easy, but it is doable. Be smart, be modern Phoenician.